Hey everyone, JC Peretz here of allstarcharts.com, and today I really just wanted to start out by thanking you for coming to our page and checking out the cool things we're building and the work that we're putting out. I really do appreciate that. If you didn't already know, All Star Charts also has a premium subscription services for investors of all kinds, individual investors managing their own portfolios, and we also have a lot of clients that are investment advisors, traders at hedge funds, pension funds, family offices, things like that. So people who are putting money to work find value in the things we're putting out. In fact, we were finalists at this year's Technical Analyst Award for Technical Analyst of the Year. We were finalists for Best Equities, Best Cross Asset Analysis, and we actually won for Best Fixed Income. So I wanted to give you a quick sneak peek at our monthly conference calls this month, and this month only, we're letting you in for the full conference call. So like I said, we're gonna start with a top-down approach, look at the intermarket and international markets around the world, the developed markets here in the United States, the major indexes, and then we're gonna break it down to the individual sectors, industry groups, and ultimately the stocks and the components within those groups. So I hope you enjoy it. So before we get into it, as always, nothing that we talk about here should be construed as any sort of solicitation or buy or sell recommendations. This is strictly for informational purposes alone. I encourage you to go to allstarcharts.com/terms, and everything is laid out nicely there. All right, so let's get right into it. Really, one of the big things that I've really noticed is twofold. Number one, I have a podcast coming out with my friend Todd Sohn, should be out in a day or two. One of the things that we talk about is really coming into the year. If I told you that interest rates would be where they are, bonds would be doing what they're doing in terms of strength of bonds and just interest rates getting clobbered around the world, what would you say that the stock market would be doing under those conditions? And it's funny, him and I both agreed. We would have said, oh my God, stocks would probably not be doing too well in that environment. And in fact, we were just basis points away from all-time highs in most of the major indexes. So I find it two interesting things. I find it interesting how strong US stocks have been in the face of that overwhelming strength in bonds. And this chart is a safety index that I created where it's adjusted for volatility. So it's going to be less gold and more bonds in yen so that it doesn't look like a chart of gold, right? And it's basically the safety assets. And just look at that strength, absolute strength. We're going to touch on gold, yen, and treasury bonds individually in a minute, but I just wanted to show you in aggregate really the strength in this safety index and the fact that we're going to look at them now. A lot of the major indexes are just basis points away from all-time highs. So that's really interesting strength. The other one is the strength in precious metals and gold in the face of a dollar that's not falling, right? And we've seen that all year long. If you would have told me where gold is today coming into the year, I would have said dollar slammed. That has not been the case either. So some interesting relative strength in the intermarket sort of sphere that we're going to touch on. The weights are, you can email me, Capillo, you're asking for the weights for the All-Star Charts safety index. You can email that to me, but it's going to be about 40% bonds, 40% yen, 20% gold-ish, basically, based on the volatility. So here's breaking down those safety components right here on their own. Really, all three, yen, gold, treasury bonds, breaking out of downtrend lines. So just relentless strength out of these more defensive areas, which just, again, to reiterate, the fact that the S&P 500 and down, a lot of these major indexes, NASDAQ, are just basis points from all-time highs. I find that incredibly encouraging for stocks. It's kind of like, man, if stocks can't get killed in an environment that these things are doing so well, like, what's it going to take to take them down, right? It's like the opposite of oil. If oil could do so well and energy stocks just can't go up in the face of very strong oil, I mean, what's it going to take for energy stocks to do well, right? So it's kind of like a similar sort of notion. If stocks can't get knocked down hard with these assets doing as well as they have been, I think that's encouraging. So here's when an asset class is in a bull market, it's in a strong uptrend, it's not just going to outperform on an absolute basis. You're going to see it doing well on a relative basis, right? It's not just on an absolute basis. It should be outperforming its competitors. So with the S&P 500 making new highs recently, notice how relative to bonds and relative to gold, we're nowhere near making new highs. So the question really becomes, is this a situation that these divergences are a heads up that the S&P 500 is going to catch down? Or is this just further evidence that no, the S&P 500 this is not the breakout, which we're going to look at market breadth, and I think it's going to suggest the same thing. The S&P relative to other assets is really suggesting the same thing that the lack of breadth is suggesting, that we're still in a range, right? Maybe a few of the indexes technically made new highs, but at the end of the day, we're still in a range. And I think these relative charts really, really tell the story. So it's going to be one or the other. Either S&Ps are going to catch down to the others, or we're going to start to get some rotation in S&Ps on a relative basis. And there's no evidence whatsoever that that rotation has started. But again, interesting further evidence, the S&P still near highs, even though breadth is not confirmed or anything like that. One of the reasons I'm hearing to be bearish of equities is the yield curve inversions. You know, we've gone back, we've done the work. As the yield curve is narrowing, that is a buy signal. When it inverts, it's historically a buy signal, right? These recessions, these tops of stock markets, they don't come till 12, 18 months, you know, depending on who you ask, depending on where you start the data set. You know, these are buy signals. So if you're going to be bearish of equities, yield curve inversions, I don't think should be one of the reasons why. Quite the opposite, in fact. Stocks historically do very, very well prior to inversion and after inversion as well. What we really want to be focused on is credit spreads, right? So here, set up your favorite credit spreads. We're still not to the widening point that we were towards the end of last year. So in other words, we're not making higher highs. That would be further reason to be concerned of stress in credit. I think that's reason to be concerned in the stock market. We have not seen that yet. Just to put things in perspective, let's take this back over a decade to show you where credit really was, so you could really see the stress during 2008. You could see an incredible amount of stress as well. You know, we don't always, you know, one of the things that I say, I can blame myself as well, but I think we all do it. We're all victim to comparing everything to 2008, you know, or 2009. Like, why do we have to do that? We don't have to do that. So we could think of normal corrections, things like 2011, things like 2015, right? Look what credit was doing then. That is not what's happening now, right? So just kind of really want to put things in perspective. We have not seen credit spreads blowing out. So I don't necessarily think that there's reason to be panicking from any sort of structural perspective, at least not yet. We haven't seen that. And I think these charts really, really show that. So if there's something in the fixed income markets, in the bond market, that is going to suggest that we need to be erring on the side of caution, it shouldn't be the yield curve. If anything, it should be the credit spreads. We have not seen them blowing out yet. If there's real stress out there, you'll see these things blowing out. All right, so here's the S&P 500. This is a weekly chart, so it does not include yesterday and today, Monday and Tuesday of this week, because that was basically a wash anyway. So this is just how candles ended last week. And, you know, is this a successful retest of that breakout? You know, this is one way to look at it after a couple of false starts. Or are we still struggling to get above the highs, right? So that's really the story here. And I'm still in the camp that while we might be, and I'll show you breadth now in a minute, and you could really see what I'm talking about. While I'm still in the camp that we might not be out of the woods just yet, we're still in this sideways range, at least internally anyway. I'm seeing further evidence, more evidence that we're going to break out. In other words, we're closer to the beginning of a bull market than we are towards the end of a bull market, like some are suggesting. Look at the Dow Jones Industrial Average, fail, fail, fail. Now we broke out. Now what's going on here? Was that a nasty failed breakout here, or are we going to dig in here and really take off after this hammer candle, if you will? The Japanese like to, you know, they like to call their candlesticks different silly names. They say that the market is hammering in a bottom. when you see these sorts of candles show up. So it really means nothing unless we get follow through. And so far, I guess we've gotten some sort of follow through, but nothing really to write home about yet until the end of the week. But if we're above the former highs from 2018, from early 2018, call it 26,600, 26,700 or so, I think that we really need to be bullish of stocks. In the meantime, I like I've been saying, if we're not above those former highs, you can see it in the S&P 500. I'm going to show you the global 100 index in a minute. But if we're not above those highs, at the very least, there's opportunity cost, right? At the very least. In other words, what else can we be doing with our money? So it's not just downside risk, because of course there's downside risk, but there's also opportunity cost. So both reasons not to be buying stocks aggressively, in my opinion. If you don't like getting whipped around, be smaller. Those sorts of conclusions, I would say, are probably the best way to proceed, right? Be smaller, no need to be a hero, no need to get cute, right? If we're above former resistance, then yeah, we can be much more aggressive. If we're not, we have the risk of getting chopped around in a dead, low volume, no liquidity month that August is, right? So things get pushed around more than they should. Think of it like that. So if you don't want to deal with the headaches, I don't think there's really any reason to do that in the month of August. But whenever in doubt, zoom out, right? So here's the Dow Jones Industrial Average going back 20 years. And man, this was a perfectly logical level. You know, I know there's a lot of new members out there, so welcome aboard. You guys who've been around for a while have seen this chart before. We've been pointing to this chart ever since that breakout in 2016, right? Because that was the target. And sure enough, that was a target for a reason. And the market has been flat for what? 19 months or whatever it is now. You know, I think ultimately we do break out. And this chart really goes to show you how much upside there really is. If we're above 26,600, 26,700, that area, man, there's a lot of upside to go. So this is one of the charts that to me leads me to believe that an upside resolution is a higher probability outcome than this being a major top. So 26,700, we're above that. That's really confirming the direction of the market, in my opinion. The Dow Jones Transports has been the underperformer, right? New highs in the industrials have not been confirmed with the transport. So the Dow theory extremists still have this as a sell signal market, if you will. I'm not really that strict about it. For me, it's more of just kind of like a confirmation sort of thing. Are we in an uptrend? Are we in a downtrend? I think both of them are in sideways trends. I mean, that's really what it is. The industrials are near the upper end of the range, and the transports are near the lower end of the range, but nonetheless, sideways market. So if we could start to see some rotation into transports, and one of the things I encourage you to do, for you guys who like putting in the work, I know there's some people who are like, well, JC, we'll just take your word for it. That's why we like what you do, and that's cool. But for those of you who also like to do the work, I encourage you to go through all 20 charts of the Dow Jones Transportation Average and go through them one by one on a weekly basis and on a daily basis and on a daily time frame. In other words, weekly charts and daily charts. So 20 of those. So it's 40 charts. It'll take you no time. 40 charts, and just try to come up with what sort of stocks would have to break out for the Dow Jones Transportation Average to really get going. You know, things like maybe Delta, Norfolk Southern. Look at stocks like Expeditors, right? I'm not going to show these particular charts because they're not really breaking out yet. But for transports to do well, those are really the leadership stocks that we're looking for to break out and drive this market higher. So there's just a few names to sort of keep an eye on, but go through all of them. I encourage you to do it. It won't take that long. So here's the Dow Jones Composite Index, which includes the 30 industrials, the 20 transports, and the 15 utility stocks in the Dow Jones Utilities Average. So 65 stocks overall. And here's how I look at it, right? Here's the resistance in 2018. If we're above that, the January highs from 2018, it's tough to be bearish to market, right? In the meantime, I think we need to err on this being a sideways range. Same thing with the NASDAQ 100, right? Really flirting with deciding what is it? Is it going to be a failed breakout and down we go? Or is it still trying to iron in this base and really get going? And I would argue it's probably the latter. And let me show you some examples of why. So the small caps, like the transports, have been the underperformers. So the mid caps, the micro caps, the small caps, all not making higher highs like the S&P 500, the Dow, and the Nasdaq, and the technology sector and the discretionary sector have all made new highs. These have not, right? So again, this is more like a breath measurement, suggesting that no, we're not out of the woods just yet. We're still in this range. We're still below overhead supply. And I think if we start breaking out above 160, I think that's evidence that we could really get going. That seems to be the battleground in small caps. And then we start to see some follow through in mid caps and micro caps. I think that suggests that perhaps maybe small caps are ready to outperform, which we'll look at in a minute. But here's a look at what the S&P 500 just did, put in a higher high, and the small caps did not, right? Putting in a lower high. So is this a divergence that years from now we're going to be pointing to and be like, hey, aha, that was the divergence. That's when we knew that there was a problem. I'm not really buying that right now. At least I haven't seen enough evidence to suggest that that's what's going on, and that there's just a few stocks still making new highs, and the S&P and the Dow are going to get destroyed and follow the Russell 2000, right? I still don't see that specifically in the Russell 2000. All right, so when it comes to the outperformance, right, these are small caps versus large caps. And as we've known, the small caps has just been underperforming forever. But we're down to the same level that we bottomed out in early 2016, right, in the small caps relative to the large caps. Stephen is asking about the, here, hold on real quick. On the 151 level, yeah, there's no doubt about it. I mean, I'm looking more like the 160 level to really get above this, but you're talking about here, really that 151 level to break out above the downtrend line. And yeah, I can see that. But the truth of the matter is, this 160 area has been a lot of trouble. So until we're above that, I have to err on this continuing to be in that range. Yep, exactly. That's exactly right. So if we're gonna start to see outperformance out of the small caps, this would be a logical place for us to see that, right? So we really want to pay attention to that. One common theme for sure that we are seeing, and we're going to get into that throughout the call, is that the tech part of the underperforming areas are the ones outperforming. So in this case, we're looking at small cap technology here pressing up against all-time highs. So these are the small cap tech stocks. When we look at financials, it's the technology financials like mobile payments that are doing well in financials. When we look at other sectors as well, it's the technology. Look at the relative strength out of the equipment stocks in the healthcare space, right? Those are tech stocks. So we're continuing to see this again and again, this theme of whatever the technology is of this underperforming area, it doesn't look bad. And I think the small cap tech is a good example of that. When it comes to sentiment, I find it really interesting that we're only a few percentage points from all-time highs in the S&P 500. And when we aggregate all of the sentiment data that we get, we are down to these levels. Every time that sentiment has been where it is today, we have seen key bottoms. This was the May bottom earlier this year, a few months ago. This was the late December bottom. This was the bottom last spring in April. So we continue to see lows marked by bearish sentiment as it is today. So I find it really interesting that this is the highest that the S&P 500 has ever been in history with sentiment this bearish. I hadn't really said that out loud until right now, but that's really interesting when you really think about it, just how bearish the market is with the S&P 500 close to all-time highs. Again, this is the highest the S&P 500 has ever been with sentiment as bearish as it is. It's hard for me to want to sell into that hole of bearish sentiment. It makes me want to be more of a buyer than anything else. So when we think globally, for you guys who have been around for a while, doesn't this remind you of early October of last year when we had all these whipsaws and then the disaster that came after? I don't think that we're going to see quite the same consequences from this particular failed breakout. I think it's probably more of a false start, and then we dig in and go. But let's take a look at some of the international indexes just to see if the components themselves agree. Here's the London FTSE 100 going back 20 years. When you talk about when I mentioned earlier, we're probably in the early stages of a bull market than we are in the latter stages. This London FTSE 100 flat for 20 years, I think, is further evidence of that. I think the Euro Stock 600 flat for 20 years is further evidence of that. We're not near the end of a bull run. I think we're much closer to the beginning. Switzerland breaking out of a 12-year base. I put out a note earlier this week showing that. Is this the leading indicator? Is this a heads up that the rest of Europe is going to go? One of the problems I have with Europe is it's this large exposure to financials. Europe doesn't have the exposure to technology that the United States has, right? But the Swiss markets have some healthcare exposure. It's helping driving that higher. But here the Swiss market's breaking out of a 12-year base. I think that's really interesting. Here's German DAX, right? If I need to, do I want to be buying this breakout or selling this breakout? Man, if we're above 11,800, we want to be erring on higher prices for German equities, right? That's it. But I don't think we're really going to get going until the financials can finally get going. And we'll get into that in a minute, but that's really dragging down European equities. The commodities have been dragging down Canadian equities for a while, but here we are. Just a few basis points from breaking out to all-time highs in Canada. So, London, Europe, Swissy making new highs, Canada close to new highs, Australia kissed the 2007 highs, right? So it's hard to expect Australia to really move out there. But again, further evidence, we're right there, right? We're very close to all-time highs. I think Hong Kong really tells the international story, just a hot mess, right? I know there's a lot going on in Hong Kong right now, so I don't mean to pick on Hong Kong specifically, but I do think that this just sort of sideways mess, I think, is a good representation of what we are seeing internationally. But getting back to the big bases, the fact that we are closer to the beginning of a bull market than the end of a bull market, look at Taiwan, flat, right, for 23 years. Thailand, flat for 25 years, right? It's hard to think that we are near an end of a bull market when you have all of these markets around the world that haven't done anything for decades. So let's get into emerging markets. This has really been the big underperformer. Dollar's been strong. Emerging markets have just gotten killed. I mean, not so much killed. They just haven't been able to get going. In terms of underperformance, yeah, on a relative basis, they've gotten killed. Could have been anywhere else other than emerging markets and done well, particularly in the U.S., right? That's really what's been working. So if it's going to get going, this got to be the area where it's going to get going, right? It's got to be somewhere around here is how I look at it, and here's why. Emerging markets and Dr. Copper look exactly the same. And right now, commercial hedgers in copper have their largest net long positions in the history of the Commitment and Traders Report. So the smart money, if you will, has more money, is betting more that copper prices are going up than they ever have in history. And while it's not the best timing signal, it's hard to ignore the extreme sentiment in copper futures right now. And if that sentiment unwinds, you're going to see a major squeeze in emerging markets. So let's look at the copper chart. Some look at it like this, right? Like a head and shoulders top, right? That's potentially breaking down. Speculators have a record net short position on. So the dumb money, if you will, the speculators are betting that copper is going to get crushed. They have never had bigger short bets ever. So to me, I think that support holds here and the commercial hedgers are right. And if we're above around 255 or so, I think we want to bet on higher copper prices. I think we want to bet on higher emerging market prices, right? That's really where we want to err when sentiment is this skewed. Think about like a rubber band, just really getting stretched out. John wants to know if the Swiss market breakout could be the flight to safety in terms of themes. Yeah, maybe. I think it's probably less that they are less exposed to banks than maybe some of the other European countries. And these bank stocks are holding them down. They obviously have some components that are dragging them higher. Take a look at the components. There's only 20 stocks in the Swiss index, so check that out. But clearly, their components are behaving better in terms of sectors than some of the other countries in Europe. Sticking with that theme in copper, though, we're talking about how we can see a major squeeze in copper futures based on the current positioning. Now, look at copper relative to the S&P 500. Copper futures relative to S&P 500 futures, and with the lower lows in the ratio, higher lows in momentum, like I said, if emerging markets are going to get going, if copper is going to get going, right, because that would happen simultaneously based on our intermarket work, this would be a very logical place for that unwind to begin. So we want to be paying very, very close attention to copper and emerging markets here. And then comparing it to other base metals out there, look at aluminum. Aluminum with lower lows, emerging markets putting in higher lows. I think that's an interesting divergence worth paying attention to as well. So very exciting stuff taking place in emerging markets and the base metal complex for sure. But just to reiterate, relative to the S&P 500, the S&P 500 is still the best house, right? It's still what's working. There is zero evidence whatsoever that the emerging markets trade outperforming the S&P 500 is something we want to be betting on. There's no evidence of a turn yet at all. But I got to tell you, if copper is going to get going and emerging markets are going to see that money flow, I would expect to see some outperformance, right? I think that would be logical. We don't have to see it, but I think that things are so stretched. I think that would make sense in a sort of environment. We have yet to see that, just to reiterate. All right. So one of the gauges that sort of risk on, risk off gauges that we like to follow is the high beta stocks relative to the low volatility. And we have yet to see that turn either. And I'll tell you why that's important, right? These divergences have led to important turning points in the past, particularly the 2015 highs, again in the highs in the fourth quarter last year. And then here we are, down the high beta versus low volatility ratio back down to where we were in late 2018. And if this can get going from here, I think that would be consistent with higher stock prices. So a ratio that we definitely want to follow from a risk appetite versus risk aversion sort of perspective. Historically, crude oil has not always been highly correlated with the S&P 500. Sometimes it's been negatively correlated. Usually it's closer to zero. However, over the last few years, we've seen a very high correlation with crude oil and the S&P 500. So if this is a nice little double bottom in crude oil, I would expect that to be consistent with higher stock prices as well. So if you start seeing crude oil breaking down, getting back down into the 40s, that is probably happening in an environment the S&P 500 is selling off. So higher oil prices, probably consistent with higher stock prices. But that doesn't necessarily mean that we want to be buying energy stocks. Not at all, in fact, right? And because, the point that some of my colleagues and I have been bringing up and sort of like joking about, I guess, I guess if you find this sort of thing funny, I guess we do, with oil really, rallying over the last 3 years, energy just cannot get a bid, right? So if energy can outperform in an environment that oil itself is ripping, when is it ever going to outperform? So it's just really not anything that we want to be betting on at this point. No evidence of that whatsoever. But bigger picture, over the last few conference calls, I've liked to show this Chevron chart. To me, this seems like a huge base developing. I'm going to show you a few charts later on in the conference call towards the end, sort of keep on the radar sort of stocks. I should have included this one with that group because this is kind of like a really interesting, slow developing eventual breakout. Because think about the implications of Chevron breaking out of a 6-year base, right? 5-6-year base. I think that would be great for energy stocks, and the market capitalization of Chevron alone, I think, is positive for the overall market. So something we'll be watching. Here's another great example of the tech in something underperforming actually doing well. Solar is the technology of energy, right? And the rest of the energy ETFs and indexes, they look terrible. But solar looks good, right? Continues to act well. I still think we get towards this 32.5, 33 target that we've had since this breakout. But just another interesting example. We're seeing small cap techs looks much better than regular small caps, right? The tech and financials, like the mobile payments, we'll get into it in a minute, looks so much better than overall financials. We're seeing the same thing in energy. So again, just further, we see it in healthcare as well. So again, just further examples of pay attention specifically to the industry groups within the sectors. I know a lot of financial advisors out there always asking me, JC, growth or value? This is a very simple chart. No evidence whatsoever here that value should be outperforming growth anytime soon. It's still growth over value. No evidence to the contrary. So here's what I was saying as far as market breadth, with new highs in the Russell 3000, right, which represents approximately 98% of all investable assets in the US equities markets, with new all-time highs in the index, we're not seeing an expansion of stocks making new 52-week highs, right? We're not getting that breadth confirmation. Stocks getting overbought. In other words, stocks in a bullish momentum regime. Again, we want to see an expansion of those stocks with new highs. We have not seen that. So no confirmation at any of these new highs that we're getting an expansion in participation. Now, on a brighter note, the advanced decline lines are confirming the new highs, right? New highs in the AD line, in the S&P 500, new highs in the New York Stock Exchange composite AD line, right? So the advanced decline lines are not really giving us any warnings, but in terms of percentages of stocks getting overbought, new 52-week highs, and percentages of stocks above the 200-day not getting confirmation with expansion at all just yet, right? And just because we haven't seen confirmation doesn't mean we're not going to get it. But this is just really further evidence that even though we've made some all-time highs recently in some of these indexes, we're really, in terms of the internals of the market, in terms of the market of stocks rather than the quote-unquote stock market, we're still in a sideways range, and we need to respect that. We like to run the numbers. I like to show you guys, we like to run the numbers and see what percentages of sectors, what percentages of global indexes are above last year's highs, how many have broken out. And I'll just leave this up for a minute so you can take a look. But the bottom line is that it's a very small percentage. So here were the stats that we ran last month. Here are the stats that we ran this month, just so you can compare. Are things getting better or are they getting worse? And I wouldn't necessarily say that they're getting so much worse, but they're definitely not getting better, right? We haven't seen improvement. I would say in terms of breadth, I would say, sure, we might be set up better because we've gone sideways longer. So in terms of a market structure, perhaps things are better now than they have been over the last couple of months because it's been more time and it's clearly digesting the 2016, 2017 gains through time since early 2018. But in terms of breadth expansion, no, things have not gotten better. And I encourage you to go back and take a look at that slide, and we'll talk about that again next month. So here's technology really retesting successfully. This is a weekly chart, so it does not include yesterday and today of the former highs from last year, right? Nothing new. If you look at all of the indexes, technology by far and away looks strong. We'll look at some of the defensive areas like utilities, REITs, staples, also breaking out of their bases. But of those non-traditionally defensive areas, technology by far the strongest one. So let's take a look at inside technology. Here's Apple. I should really, like Chevron, add Apple to the keep on the radar list. I really like this base in Apple. I really don't think there's any reason to be long unless we're above 207, which we are not. If we're above that, I like buying Apple, with a target substantially higher, especially after this base that we've seen. But if we're not above 207, I don't think there's any reason to get involved. Here's Microsoft. 132 is my level there. The question is, has that it? That 132 target? Have we hit it? Is that it? Or are we just digesting these gains before the next move higher up towards 200? And it's really hard to say, but if we're not above 132, I don't think we could be long Microsoft. Texas Instruments, a nice inverse head and shoulders, pretty classic. Finally breaking out above the 2000 highs. If you zoom this out, you could see that we are above the highs from 2000. Finally, right? It took 19 years to finally, almost 2 decades to break above the March 2000 highs. So I think that if we're above 120, we can be long Texas Instruments all day. I think this has at least another 20-30% to the upside. We only want to be long if we're above 120. Here's semiconductors, right? So these are semiconductor stocks. It moves with tech. Tech doesn't go anywhere without semis, right? You need chips for tech. So I got to tell you, if I had to buy, if I had to choose whether I want to buy this chart 100 out of the next 100 times, or I wanted to sell it 100 out of the next 100 times, I would buy this every time. And if I'm wrong, then I'm wrong. But this is a chart that we want to be buying, right? This is evidence of strength. We got back to the March 2000 highs. We've been consolidating for a couple of years. Yeah, I think we're ready to move on. Here's a closer look at that. That 1433, that has been our level for so long. If we're above that 1433, yeah, I think we need to be very long of tech, very long of semiconductors in general. I think that that's the area that we've seen strength, particularly within technology, right? Here's, and people are like, well, JC, it's only a few stocks. Well, first of all, the biggest and the highest market cap stocks are the ones that are supposed to be doing the best, right? Your best players are supposed to be scoring most of the points. But if you really want to bust my chops, these are the equally weighted semiconductors, really just pushing up against all-time highs. So we're seeing it across the board. This is a broad-based participation in semiconductors within technology. There's absolutely no doubt about it.
Hey guys, JC again. Sorry for the interruption. As you can see, up to this point, we have really broken down the global macro framework, right? The major intermarket analysis, global markets around the world, the developed markets at the index level. You saw recently some of the internal discussion, the breadth dynamics that we look at to make decisions whether we're ready to break out higher or whether more consolidation in the major indexes is necessary, right? That's the big framework. From here on in, you're going to start to see more of the individual sector work, like we just discussed technology, and the individual stocks within them. So we'll talk about things like industrials, we'll talk about things like consumer discretionaries, utilities, consumer staples, and the sector rotation between them. If you think the work that we're putting out is going to add value to you, if you're getting it on a consistent basis, I encourage you to take advantage of the discount offer that we're currently giving away. For just $11.99, you get 12 months of access to All-Star Charts Premium. So that's not just the monthly conference calls like you're watching now, but that also gives you access to my entire private chart book with over 1,000 charts that I'm updating on a regular basis. You also get access to the Trade Ideas page. And most importantly, you can contact me anytime and I'll get back to you, whether it has to do with something that you might not understand that I said on a conference call, or maybe a stock that you wish I mentioned that perhaps I didn't, but you can always contact me and I definitely get back to you right away. But most importantly, it's risk-free. So for literally less than $100 a month, you get complete access to All-Star Charts Premium. And if for whatever reason you decide that it's not for you, or maybe you're not utilizing it as much as you thought you may have, just email us and we'll send you a 100% refund. Absolutely guaranteed, no questions asked.
Communication ran up against the former highs, but listen, this continues to consolidate sideways. We can see a breakout. These are stocks like Facebook. These are stocks like Google, right? I mean, these are really important, big time stocks that, we can consider tech, right? Depending on who you ask. These are big time names. So here's consumer discretionary, really just looking to successfully retest that breakout is really what it is. And here's a weekly chart. Consumer discretionaries were actually positive last week in a rough tape. So yeah, I think that over the last couple of weeks, I think that what we've seen in discretionaries, particularly some of the individual names that we'll touch on in a minute, I think it's very, very encouraging. One thing that's not encouraging is that with new highs in the S&P 500, we've seen lower highs, two consecutive lower highs in this particular ratio. So what I'm doing is I'm making a basket of the offensive sectors, right? Financials, tech, discretionaries. These are equally weighted, these baskets. And then I take the defensive areas, staples, utilities, healthcare, and make a basket of those three sectors equally weighted. And then I compare the two. Right? And it's been great information in the past. It helped us tremendously to get bearish early in the fourth quarter last year. So the question is, we have no new highs in this ratio, or is it we have no new highs yet? Right? So are we going to see that rotation? I think it's going to take participation out of financials because tech and discretionaries are doing their job. It's really the financials that are slowing things down, which is also the problem in Europe. So what's the solution? Well, don't worry about financials. The hell with financials. Look at tech and discretionary, right? If you're an energy trader, you're like, yeah, this market is terrible. But if you're a tech trader, you're like, man, this market is great. So I think it just, really it's important to pay attention to where specifically something is working or not working. If we can get some rotation into financials, because we don't really have bull markets in America without financials participating. And while, yes, there's outperformance out of the mobile payments areas and things like that, we're simply not seeing that out of the money center banks, which traditionally we need. So looking for some rotation into financials. I got to tell you guys, if the world was actually coming to an end, like so many keep saying, I see it on the Twitter, I get emails about it, I'm aware of what's being said out there. The world is really coming to an end. Are these home construction stocks really going to be pressing up against new 52-week highs? I really don't see overwhelming strength in home construction as evidence of impending doom in the stock market. I look at that as constructive for sure. So because we've been in a relatively weak tape and home construction has acted so well, that relative strength is evidence that we need to be buying home construction stocks. Look at DR Horton, DHI. Here's a weekly chart. For above 42.5. I like this long. I think we go to 66.5. Here's kind of closer look, just a nice base, right? There's absolutely no doubt about it. Here's Pulte, again, holding above this important level. Let's call it 31. If Pulte's above 31, I like it long to 40. Just a home construction, home building, that whole space, I think, is encouraging seeing that strength. Home Depot, of course, really a fan favorite. 207 is our level here. Home Depot, 207. If we're above that, I think we could be long HD. We want to be buying this pullback. If we're not above 207, then we got bigger problems, right? We're below overhead supply. There's opportunity costs, all things that we don't want in our portfolio. So if we're above 207, I like it long to 237 in the Home Depot. Walt Disney is really just a Fibonacci lesson, is really what it looks like. How it's really respected this Fibonacci extension level. That was our target. It hit our target. Here's a closer look at what's going on. 144. If we're not above 144, I don't think there's any reason to be long. That's really the measured move target. If we're below that, really no reason to be involved. If we're above 144, yeah, come talk to me. Definitely like it long above that. In the meantime, it's really just a nice Fibonacci lesson. Speaking of Fibonacci, Chipotle was really down in the dumps about a year and a half ago. Talk about relative strength while the overall market has done nothing. Like they say, there's always a bull market somewhere, and clearly it's been in bad burrito places. Chipotle is above its 2015 highs. They like it. The institutions like it. Whatever it is, I think they were poisoning people when the market was down here. I guess they're not poisoning those people anymore, which is great. I don't necessarily think we need to be piling in here this very second, but just think about it conceptually, structurally. If we're above 750, this is a long all day. We can go to 1,000. So to really reiterate the fact that we're really in a sideways range in a lot of these markets, look at industrials. I mean, this is just the sheer definition of a sideways range. Look at materials, just a sideways range. Healthcare, sideways range. Financials, sideways range, right? I mean, there's just really no other way to put it. None of these are strong bull markets. They're not bear markets. They're just a sideways range. Let's do that again. Ready? Industrial, sideways range. Materials, sideways range. Healthcare, sideways range. Banks, sideways range. I mean, that's really just what it is. And then taking a step back and zooming out on financials, we're still not above the 2007 highs. So when we talk about how, the market is out of control, it's gone so high, it's done so well, financials are still negative off those 2007 highs. So Goldman Sachs, probably the poster child of that. Here's that Head and Shoulders top that broke down. One of the reasons we were bearish in the fourth quarter last year. Well, we've returned back to that neckline, and it's just a struggle, right? There's no evidence at all that we're in an uptrend in Goldman Sachs. JP Morgan, on the other hand, really just a mess over the last 18, 19 months. To me, is this like a major top here? Something like this, or, something like this? Or is this a consolidation within an ongoing uptrend that's going to resolve higher? I'm still in the camp that it's the latter, right? So if we're above 110, that thesis is intact. If we're not, it is not intact, right? So here's sort of the examples I showed you before: industrials, materials, healthcare, financials. Here's JP Morgan, right? Just a mess, sideways, absolute mess. So, from a tactical perspective, I'd rather be waiting for the breakout, right? From a structural perspective, if we're above 110, that's encouraging. Tactically, I'd rather be out of this mess, right? That's the difference. Know your time horizon. So with home builders doing so well, here's the home construction index down here, and then the regional banks we're still waiting for that push. We've had some interesting positive correlations between these two areas. We have yet to see regional banks participating to the upside. That seems to be the same story I keep saying again and again. Technology doing well, financials not, right? But within the financial space, the mobile payments are doing very well. In other words, the technology within the financial sector is the area that's doing well. Here, mobile payments relative to regional banks. I mean, you want to talk about uptrends. This is a powerful, powerful uptrend. Clearly, the trend, the money flow is going into mobile payments, not regional bank stocks. So I think this chart really, really tells that story. So here's a closer look, right? No evidence that there's a downtrend in mobile payments. To the contrary, this still looks like a healthy uptrend to me. So a few stocks that look good. MasterCard, I think, continues to look good. Let's call it 260. If we're above 260, we want to be long MasterCard with a target above 312. Look at American Express. 111's been our number. If we're above 111, we want to be long with a target near 157. Visa continues to look good. 168 is our level. If we're above 168, we want to be long Visa with a target near 230, right? So all these credit cards, mobile payments, this is what's working. Look at Fiserv, right? And listen, I'm showing you these because these are good examples, not necessarily because we need to have a diversified portfolio of all of these. In some cases, they're just further examples that the trend here is not down. It's very strong and up. Fiserv making new highs. 106 here is really the level. If we're not above 106, I don't really think there's any reason to be involved. But just really breaking things down closely. If we're above 106, I think we could be long for another 20, 25% of upside here in Fiserv. No reason to be long if we're below 106. Here's FleetCor, another good example. We don't necessarily have to be piling in, just a good example of these mobile payment companies continuing to do well. The other financials that are working are the insurance stocks, right? We've talked about the reinsurance names like Marsh & McLennan and Willis Towers, Aon. Those names have been working very nicely. But let's take a look at some of the other names. Look at Chubb. Chubb breaking out to new all-time highs. Here's a closer look. I'm looking at 156, right? So if CB Chubb Limited is above 156, we want to be long with a target near 178. And just to put things in perspective, this is a big time uptrend consolidation, and in my opinion, a fresh breakout. So if we're above 156, we want to be long of Chubb. Look at Cincinnati Financial, also in the insurance space. For above 100, we want to be long with 50% of upside in CINF. Look at Assurant, AIZ. Look at this nice breakout. Looks like Chubb, right? If we're above 108, we want to be long AIZ. I think we go to 166. And again, these are just a few examples to show you the strength in the insurance stocks. Doesn't necessarily mean we need to buy them all, but maybe if it gets you thinking in that direction to really put these things in perspective, I think that adds value. Because financials are not JP Morgan and Goldman Sachs and UBS. There's insurance stocks and there's mobile payments and there's technology within that. I think is really interesting to take note. All right. So in the more defensive areas, utilities, new all-time highs, real estate, new all-time highs, consumer staples holding its breakout, really showing that strength. So in the more defensive areas, that's really been where the strength is. It's not a coincidence that we're seeing that in an environment that interest rates are getting slammed. A lot of these sectors like staples, utes, real estate investment trusts, they pay high dividends, right? So with interest rates getting slammed, you're going to see that flight. You're going to see that sympathy bid in higher dividend paying stocks, right? Because fixed income investors aren't getting their yield in the bond market. So you're going to get that sympathy bid in the stock market, particularly on a relative basis. So there's definitely an interest rate factor going on in some of these defensive areas. However, with the S&P 500 making new highs, we are seeing consumer staples outperforming the S&P 500. So this chart below is S&P as the numerator, consumer staples as the denominator. So in other words, staples on a relative basis flipped upside down, right? If that makes sense. So that's why they look exactly the same, because when S&Ps are doing well, consumer staples tend to underperform. When S&P 500 is doing poorly, staples will outperform, right? So with the S&P 500 making new highs, consumer staples outperforming, that's not what you're looking to see, right? We want to see the consumer staples underperforming, which is what a higher chart here would signify. So we're definitely looking for rotation, perhaps into financials and out of staples, but no evidence of any of that just yet. Few things on the radar. Industrials flat, right? This is, industrials. I included a lot of lines here. I like to keep my charts clean, but because this is just a messy chart to begin with, to clean up, to put lipstick on a pig, for what, right? It's a mess. So the chart's going to be a mess too. It is what it is. Um, we've gone nowhere since the beginning of 2018, right? So if industrials have the highest R squared versus the S&P 500 traditionally, right? And the argument that we're making is that even though we got new highs temporarily in S&Ps and the Dow, that the breadth, the internals of the market, the overall components are really suggesting that we're still really in this mess. I think the fact that industrials are still below their early 2018 highs is further evidence of that, right? So that fits within that thesis that we're still in a sideways mess thesis. Be small, manage risk, don't be a hero. It's freaking August. Everyone's in the Hamptons. Like, all of these things that we're already thinking, this is further evidence of don't be a hero. It's kind of how I look at it. So if we're having a conference call next month, or I write a blog post next month or the month after that, and I'm talking about industrials above 81 breaking out to all-time highs, that's most likely happening in an environment that stocks are doing very well. We're breaking out. We're probably getting international participation, right? Think about what's going to happen with industrials breaking out to new all-time highs. In the meantime, near a flat 200-day moving average, this is the perfect example of a hot mess. Another one to keep on the radar is the agribusiness, right? This is in the material space. Here we are pushing up against former all-time highs in 2008. I think if we're above 68 in the agribusiness sector, man, I think that's good for materials. I think there's a lot of interesting stocks in that space that will be doing well. We haven't broken out yet, but I think it's definitely worth keeping on the radar. Amazon's another one. I don't know if it's the biggest company in the world today. I think it was yesterday. Today's Microsoft or Apple. I forget which one's which, but it's one of the biggest, obviously. The fact that we've done nothing for over a year, I think, is really encouraging. I think it's further evidence that we're probably closer to the beginning of a new cyclical bull market than we are towards the end, when some of the biggest, one of the biggest stocks in the world, or a few of the biggest for that matter, have already been consolidating and really haven't done anything. So if they get going, that's really consistent with higher consumer discretionaries, which is consistent with higher stock prices. Another one, CME, within financials, we talk about the tech and we talk about the insurance, but one of the things within financials worth noting for sure, and you guys who have been here for a while, know these have been huge winners. Look at CME hitting this 211 level. Moving forward, we want to see this consolidate some, right? As it hits this target, let things digest before really piling in. But I think it's definitely one to keep on the radar, particularly the whole space, right? Look at ICE, the Intercontinental Exchange. If we're above 86, I think that's encouraging, right? Because that's the extension target. And if we're above that, I think we have another leg ahead of us. So these names definitely worth keeping an eye on. Here's a closer look at ICE. This 86.5, 87 level. If we're above that, really hard to be bearish. So a couple of interesting levels to keep an eye on. S&P Global, one of the best performing names out there for sure. 255, really an important level. I think it's worth keeping an eye on just because of the sheer strength that we're seeing out of this stock. Not just now, what we've seen it for a while. Obviously, look at 2017. We've seen a lot of strength out of this name, so it's worth watching. And if we're above 255, man, I think we can have another 65, 70 points to the upside. Another interesting name that we've liked for a while that hasn't done much, but could fit some needs. Again, speaking of technology, doing well in an environment, Verizon, if we're above this 53 level, I think it's encouraging. I think it's encouraging if we're above this 53 level. And one of the things that gets unnoticed is the dividend that they pay. So to be clear, when we're doing technical analysis, we're not looking at dividend adjusted charts. We're looking at price only, right? We're analyzing the behavior of market participants. And by including dividends, we're not able to truly identify where the supply and demand is. But from a stock ownership perspective, particularly from a longer term time horizon, look at the total return in Verizon, right? So let me just go back real quick. This is we have yet to break out above the 2000 highs in terms of price only, right? But in terms of total return, remember when the S&P 500 broke out above its 2007 highs in 2013, so did Verizon's total return. So the stock has really been working, particularly if you're including all the dividends, right? That's really where the money has been. So I just want to make it, just bring up this sort of phenomenon. While it hasn't done much on an absolute basis, when you include the dividends, Verizon has been working very, very well. So we're not doing technical analysis on the total return, but I just want to reiterate that there has been quite the steady return in Verizon. So something to sort of take a step back and consider when looking at that name. I've been waiting for the dollar to roll over all year, right? The whole year. I came in. I think go back and read the first quarter playbook coming into 2019, and I'm like, yep, we're buying gold because the dollar's going lower. Well, I got the buy gold part right, but the dollar going lower, I got wrong, which is two things. It's interesting. The dollar hasn't gone lower, but it hasn't got higher either. So I haven't been totally wrong. But what I think is really worth paying attention to, and I've mentioned it a few times, is just how well precious metals have done this year without the dollar falling, right? So the fact that I got the dollar wrong and gold right, forget all that. It's more what information are we getting from that, right? Seeing how strong gold has been without the dollar falling. So was this recent failed breakout, was that it? And now the dollar comes tumbling down? Like I've been saying all year, if we're below 98, that's the bet we're making. Lower dollars. So if the dollar is going to fall, what's going to do well? You'd imagine euro is going to do well. So if euro USD is above 112, we want to be betting on higher euro and lower dollar, right? 112 to euro is the 98 to the dollar as far as I'm concerned. Momentum on a weekly basis is still positive in the euro, believe it or not. So I think the squeeze can really get going. We have our levels. We know where we're wrong. 98 on the dollar index. If we're below that, we want to be bearish. 112 in euro. If we're above that, we want to be bullish, right? That's the bottom line. The setup is there. So now we just let the market do its thing. Relative to yen, we talked about yen as really one of the safe havens, along with bonds and gold, that have really been doing well. So this is now that we're on the dollar subject, dollar yen breaking down, strong yen, further evidence of a weaker dollar. So that's really interesting. The real correlation here that we want to pay attention to is this is yen as the numerator in black, and then in blue is gold miners on a relative basis. They look exactly the same, right? When one goes up, the other one does. When one goes down, the other one does. So if we're bullish of gold miners relative to the market, which has been working, we're looking for higher yen as well, lower dollars, right? So that's really the correlation. So up here, we have the US dollar index itself, which is what, 60% euro-ish, some pounds, some yen, Swissy, Aussie, and CAD, right? And this is the dollar index inverted. So when it's going up, that means the dollar's going down. And when it's going down, that means the dollar's going up, right? And the reason I did that is so that it looks exactly like gold. So with gold breaking out now, right? Notice how the tops and the bottoms come simultaneously. With gold breaking out to new 6-year highs, what are we expecting from the dollar? I would expect this chart to be going up, which means a weaker dollar. I think that this is much less likely, right? This would be the other alternative where the dollar strengthens and gold weakens. That's not what we're seeing. We're seeing gold stronger, so I would expect the dollar to weaken, not the dollar to strengthen with gold weakening, right? So I think this scenario is much less likely, and I think the higher probability outcome is the dollar finally rolls over, right? I was taught we want to buy smiley faces, not frowny faces, right? And here's the smiley face of all smiley faces. Finally, the gold bugs have something to cheer about. After so many years of underperformance, they're finally going to have their day. I think I wrote a blog post like in March. The gold bugs are finally going to have their day or something like that. Look it up. But I told, I was like, hey, finally. I mean, what is it? Sun shines even on a dog's behind sometimes. It's a breakout, right? Can't argue with that. Can't be short from any sort of intermediate term time horizon. And if gold's going to be doing well, I would expect Swiss franc to be doing well. Notice how they look exactly the same. So just really interesting correlations here historically, and we want to be watching for higher Swissy. And if we see higher Swissy, what's the dollar doing in that environment? I would argue it's probably weaker, right? So there's that sort of thesis. That major double bottom in silver that we've been talking about is still in play. We're getting breakouts in silver, really confirming the behavior that we're getting in gold. So everything that we expected is really playing out in the precious metal space. I think that, sure, can we get some pullbacks? I think we absolutely will. I think those pullbacks need to be bought. I think that this new uptrend in precious metals is here to stay. I think this is for real. Unless we get a major breakout in the dollar index above 98 that holds, we want to be betting on precious metals very aggressively, right? So while I'm talking about how we don't want to be aggressive in the stock market, I think we could be much more aggressive buying pullbacks in precious metals for sure, if the dollar index is below 98, right? So I just want to be perfectly clear about that. But I really like the precious metal space. I think we could be aggressive. Here we're looking at, when I talk about the crazies, what are the crazies doing? If you're in the equities market, you're looking for beta, you're going to be in the small caps. If you're in the precious metals market and you're looking for beta, you're not going to buy gold, you're going to buy silver, right? So I look at the Russell 2000 versus silver ratio. To me, this looks like a perfectly logical area for silver to be outperforming Russell 2000. In other words, for precious metals to continue to outperform the stock market. And if precious metals are going to do well and copper is going to do well with the short squeeze, what's going to happen, right? What's the stock that we want to be buying in an environment that copper and gold are doing well? And that's Freeport-McMoRan, right? So $10. If we're above $10, we want to be long Freeport. It's that simple. If we're not above $10, we don't want to be long Freeport. We'll probably be down here somewhere. Copper's probably not doing well in that environment. Gold's probably not doing that well in that environment either. Copper and gold, right? If we think those are going higher, which based on the data that we have, I think is the higher probability outcome, I think Freeport's going to do well. But again, from a risk management standpoint, we only want to be long Freeport if we're above 10, and we could be looking at a double. Why can't we get back to 20 where we were early last year? I think that's exactly where we can go. Finishing up with some interest rates, we're in no man's land, right? So we were looking for perhaps an opportunity to short bonds if interest rates were above 207. Interest rates have not been above 207, so there hasn't really been a trade here. And then here we are in no man's land, completely in no man's land. We're below overhead supply from broken support, and we're well above former support from the last couple of years. So really, absolutely in no man's land. Here's just a closer look at the daily chart, right in the middle, below overhead supply, well above former support. And if you really want to get down to it, we can make it look like this, right? Where we originally broke out in rates, we're back down to those levels. So can we find support near this 160? Could that have been it? Absolutely. There's no question about it. That could have been it. I'm not really necessarily seeing that on the interest rate front, but from the bond market, as far as I'm concerned, do we want to be buying bonds right here as we approach the highs from the summer of 2016? Is that something we really want to be doing, right? We just walked through all these charts. Some of them had great risk rewards, very much skewed in our favor. Some were just uptrends that sort of reiterate what sort of trend we're in a particular sector or industry group. And now I'm showing you this chart here, U.S. Treasury bonds. I'll ask you, is this what we want to be buying? Running into resistance? Is that really what we want to be doing? I would argue, based on the evidence that we have right now, my answer is no. I do not want to be buying Treasury bonds as we approach the all-time highs from the last couple of years, right? That's just not something I want to be doing. So I do want to be doing a lot of the other things that we discussed for sure. And we'll have all of the trades laid out in the trade ideas page. But just to finish up with one last correlation, that while I don't necessarily want to be buying bonds, there's no evidence that bonds have peaked and interest rates have bottomed. With new lows in interest rates, we're getting new lows in copper gold ratio, new lows in regional banks REITs. So while I don't want to be buying these bonds as we approach these former all-time highs, there's no evidence to think that interest rates have absolutely bottomed. Quite the opposite. Commodities and stocks are essentially confirming what the bond market is saying.
Hey guys, JC again. I hope you enjoyed the conference call. We do this every single month for premium members. So I encourage you to take advantage of this discount offer that's going to be going away very, very soon. And again, for just $11.99, that's less than $100 a month, you get complete access to All-Star Charts Premium. That includes the conference call, just like you saw, every single month, access to my private chart book with over 1,000 charts that I'm updating regularly, stocks, interest rates, bonds, commodities, currencies, intermarket relationships, marijuana stocks, cryptocurrencies, Canadian equities, monthly candles, weeklies, dailies. We look at all of them, not just on an individual basis, but collectively, of course. And more importantly, you get complete access to me using the contact page. So any questions that you have at all, feel free to reach me. And remember, this is completely risk-free. So if after 30 days you decide that it's not for you, we will give you a 100% refund, no questions asked. You have nothing to lose. Click the button below and join us right away. And don't forget to email me after you sign up and let me know where you're from, and we'll start the dialogue like that.